we'll see limited companies related illustrations and others and small concepts. Before you begin this chapter, you have to understand income statement preparation and statement of changes in equity also be studied. Statement of financial position, especially here, we'll be studying only equity part. The income statement is similar to the statement we studied in your financial statements chapter, so you better have a glance over that chapter. And the predominantly in this limited companies chapter, we expect the changes in equity will be presented as a statement of changes in equity. And in case of financial position also, you just go and study the financial statements chapter for the format and methods and logics and all. Also refer for equity part in this chapter. Only the equity part is totally different. We will be dealing that one here. So in limited companies, two aspects are going to be covered. One is all about statement of changes in equity. Another is all about equity part of the financial statement. Rest of the things are same. So our focus is to understand these two concepts. Equity part in this chapter. Now, equity shareholders might have invested the money, will be named as ordinary share capital. So, ordinary share capital. Every year they earn the profit. Out of the profit, they may keep aside for the future requirement that is called general reserve. 1000 rupees is the ordinary share capital. And general reserve on this being is nothing but the amount transferred from the trade means the profit for the year for the future requirement is called general reserve, probably another 200 rupees. And after distributing the dividend to the ordinary shareholders, whatever the amount left over, no, is called retained earnings. So in your income statement, revenue and expenses, you will get the profit for the year. Profit for the year, maybe 1000. Then you will prepare financial statements. In that financial statements, okay, you have to prepare equity and liability. Equity and liability. Under that, equity, ordinary shares. Ordinary shares. Now, ordinary shares in the beginning they may have say 10,000 rupees. And this is the balance, initial balance. Ordinary shares. And we have the general reserve as well as retained earnings also. In the beginning, we have 10,000 rupees ordinary shares. Reserves may be around 1000. Retained earnings being 600. In the current year, we made a profit of 1000, you know. That profit will be addable. Profit for the current year. Profit for the year. 1000 rupees is added. And equity shareholders may be paid. Equity shareholders may be paid dividend for their capital contributions. Probably assume 200 rupees. That will reduce the retained earnings. And for the whatever the profit we earned for the future requirement, an amount is transferred probably from retained earnings to GR. So we transfer retained earnings to GR, general reserve. 300 rupees is transferred, so it should be subtracted from the retained earnings and 300 rupees is added in the general reserve. Whatever the profit we earn may be distributed immediately. Some amount may be kept aside for the future requirement. After these two subtraction, whatever the leftover profit we have, we know is called retained earnings. 1100 is the retained earnings. In your general reserve for the future requirement, okay, 1000 rupees is the opening balance, and with that retained earnings 300 rupees is added, then it becomes 1300. And there is no any change in the ordinary share. If there is any fresh issue, then it will give a rise to the ordinary shares, but we assume there is no any change. This will be called as statement of changes in equity. Hope you will be now able to understand. After that, after that, you have to incorporate that in financial statement, especially equity and liabilities. Under that balance broad, we have to start with equity. Under that equity, ordinary share capital, being 10,000, general reserve 1,300, and retained earnings 1,100. That's how you have to record. Hope you'll be now able to understand. This is the main block you have to understand. This one you might have studied in your financial statement, income statement. This one also you have studied in your financial statements chapter. Here, after the preparation of the income statement, the amount what we earned will be handled differently. A part is immediately paid, that will be named as dividend. A part may be kept aside for the future requirement, that is called general reserve. Subtracted from the retained earnings and added to the general reserve. After all these changes, what could be the final value for the shares and general reserve and retained earnings will be transferable to the financial statement under equity share section. There, ordinary shares and general reserve, retained earnings will be recorded. Hope you'll be now able to understand. So this is the logic. So it may be not only transfer from retained earnings to GR, it may be other way also possible. If there is a shortage, we can withdraw from GR for our current year's requirement, retained earnings. Also be possible. Transfer to general reserve or transfer from general reserve. So that's a closing balance that will go to your statement of financial position under equity and liability, especially under equity section. Ordinary share capital, general reserve and retained earnings are going to be posted. Is that clear? We'll now start with the first illustration. Question number 1. So from this question number 1, prepare statement for changes in equity. What are the things are there? Ordinary share, general reserve, retained earnings. These are the three things we have. We'll start with that same. So share capital, and general reserve, and then retained earnings. Collectively, we can have one more column for total. Following information is taken from the statement of financial position of C Limited at 1st September 2021. As we prepare only changes in equity, I never bothered about the debentures, so I'll start with this one. So balance brought down. The balance as on the date 2,40,000, 36,000, 22,000. So overall value being 2,98,000. During the year ended 31st August 2022, at a final dividend payment of $12,000 was made for the year. So dividend paid. If you are paying the dividend, it will reduce the retained earnings you have. So 12,000 should be subtracted from here. $12,000 is subtracted. An interim dividend payment of $0.2 per share was made for the year ended 31st August 2022. Apart from that, this is assumed to be final dividend. Final dividend is nothing but dividend payable in the year end after getting the permission. And in case of interim dividend, it may be dividend payable during the year, which is 0.2 per share. 2 per share. 0.2 per share. Now, how many shares we have? I think 0.5 is the value per share. $0.5. 2,40,000 divided by 0.5. Okay, then you'll get the number of ordinary shares. 4,80,000. Okay. 4,80,000 ordinary shares were issued and price being half a dollar. 4,80,000 into half a dollar, 2,40,000. Otherwise, you can calculate the numbers here. Now that interim dividend being 0.02 per share, here the number of shares being 4,80,000. You multiply that 4,80,000 with this, so you'll get 9,600 being the value. 9,600. You have to subtract. Then transfer $11,000 was made to General Reserve. So transfer to GR. Transfer to GR in short. 11,000 will be subtracted from the retained earnings. Amount subtracted in the retained earnings will be now added to the General Reserve. Added to the General Reserve. Fourth, at 31st August 2022, the company proposed a final dividend of 10,000 for the year ended 31st August 2022. This is only a proposed. As it is only proposed, not currently paid, may be payable in the next year. Never bother about to record in your changes in accounting equity or equity shares, right? Fifth, the revenue for the year ended 31st August 2022 was 3,10,000. And then the profit before debenture interest being 23,000. So how do you prepare? Revenue or profit before interest. Profit before interest. Calculate this way, right? In your financial statements, revenue. From there you can subtract the cost of sales and other costs. This value being okay, this will be called gross profit, and from there other costs are also be subtracted. You will get 23,000. This is called profit before interest, otherwise operating profit from operations. Now we have been given debenture 60,000 for that 5% interest. 3,000 will be the interest you have to subtract. This is called interest on debenture. So profit for the year here being 20,000. Now you post that 20 here. This will be addable to the retained earnings here. So this is called profit for the year. Now find out the total. There is no change in share capital, 2,40,000. And here 47,000. From 22 you add 20 and deduct these three items. Then ultimate value being 9,400. So total being 2,96,400. Better get the total for each and every item separately. Here 20,000, 12,000 negative, 9,600 negative, 11,000 negative. Hope now you'll be able to understand this part. Question number 1 is over. Clear? This sum carries 7 marks. So the key points to be noted here is, if the dividend given in absolute value, then you can directly transfer to the changes in equity. If the dividend is given per unit basis, per share basis, find out the number of shares and then multiply with 0.02. Sometimes they may give in percentage also, then you have to multiply with that percentage here. In case of proposed dividend, never bother about that. It may be payable in the next period, so you can adjust that in the next period, not in this year. Let's move on to the next question number 2. Okay, in this question number 2, prepare the statement of changes in equity for Y Limited for the year ended. Using the information from your statement of changes in equity, prepare extract from the statement of financial position, especially equity and reserve sections only. Okay, equity and reserve section. 7 plus 2, 9 marks. This is one of the easiest content where you can score decent mark here. Y Limited financial year ends on 31st December each year. On 1st January 23, the company had 8 lakhs equity shares of $1 each issued fully paid up. So We'll start with 1st January 23. On the date, the balance being, okay, what are the things we had? Ordinary shares, share capital, and general reserve, and retained earnings, and you can have a total column. Initially, we had 8 lakhs ordinary share at $1 means 8 lakhs dollar in total. 3 lakhs 5% redeemable preference shares of $0.5 each. So 3 lakhs into 0.5, this will be 1 lakh $50,000. But anyhow, we are going to bother about changes in equity only. This is equity only. Okay. Now, retained earnings $62,000, general reserve 78,000. Then overall total being 9,40,000. 9,40,000. Retained earnings is 62. Okay. Retained earnings 62,000 and general reserve 78,000. Overall total 9,40,000. 9,40,000. Y Limited provided the following information. Proposed final ordinary share dividend $43,000 for the year ended 31st December was paid on 31st March 23. Okay. So the year ends on which date? 31st December. So we are going to prepare for which period? 1st January 23 to 31st December 23. Here the payment is for this proposed dividend being 31st March 23. As the payment falls in the financial year for which we are accounting, this 43 should be incorporated, will be recorded here. So dividend paid. Dividend. Final dividend. Always the dividend will be paid out of the retained earnings. So I am going to subtract from here $43,000. Interim dividend, ordinary shares dividend 40,000 was paid. So this also be paid within the same period. So it should also be subtracted. So interim dividend, the value being 40,000 minus 40. Profit for the year ended 31st December 2023 was 1,26,000 before the payment of preference share dividend. So then preference share, how much we have? 1,50,000 on that 5%. So 1,50,000 preference shares, 3 lakhs rupees into 5%. So you can directly calculate 5% on this. This will be the number of redeemable preference shares, then value being 1,50,000. So you have to understand the difference between number and rupees, because while multiplying that 5% should be multiplied on the rupees, right? Not on the numbers. For every rupee 5 paise will be the dividend. So for that 1,50,000 into 5% will be taken. What is the value? 7,500. That will be subtracted from here. Then 1,18,500 is the profit for the year. I have to add that here. Usually you have to write here in the very beginning itself. So 1,18,500. Okay. So I'll write here profit for the year. Profit for the year 1,18,500. You better leave a space for this. You have to post here better. On 31st December 23, the company decided to transfer $32,000 to its general reserve. So we are transferring from P&L account retained earnings to general reserve. So in your this account it is going to be subtracted and here it is going to be addable. So retained earnings to general reserve, transfer to general reserve. Agreed a final ordinary share dividend for the year 6%. Agreed, not paid. As it is being only agreed, not paid, you no need to bother about this one. Okay. Now finish up tally. totaling, so 8 lakhs. This will be 1,10,000. This will be 65,500. Total value being 9,75,500. So here 43,000 should be subtracted. 40,000 should be subtracted. 1,18,500 remains as it is. Here it will not have any balance. Okay. Here it should be 0. Okay, I missed in the previous illustration. Plus 11 minus 11 becomes 0. So in this case also it should be 0. Clear? Apart from that, we have to prepare equity section only. Okay, equity section. Under equity section, start with ordinary share and general reserve, retained earnings. Ordinary share being 8 lakhs. General reserve 1,10,000. Retained earnings 65,500. The total being 9,75,500. Hope you'll be now able to understand this one. This question number 3, we have been given trial balance. So prepare income statement. Requirement being income statement to be prepared for M Limited. So the income statement you might have studied in your financial statements chapter. You bring that knowledge from there to here. Prepare statement of changes in equity there later on that you have to prepare this one. Okay, 7 plus 5, 8 marks. Let's start with preparation of a income statement from this information. This trial balance, M Limited. Okay. Yeah. Now adjustments. Inventory. Year-end inventory being 12,830. 12,830. And the depreciation on equipment is charged at the rate of 25% per annum using reducing balance method. Okay. Where is that? Equipment. You have to subtract the provision for depreciation and thereafter you have to calculate 25% depreciation. Accrued operating expenses on 30th November were $415. So we are going to prepare only the last month. The last date being 30th November. So this is the last month expenses being outstanding, 415. So operating expenses. That's an outstanding of $415. Rent includes a payment of $2,250 for the 3 months from 1st October to 31st December 2021. Okay. So 1st October 2021 to 31st December 2021. But here you have to prepare only for 30th November 21. For this period, the rent payment being 2,250, and this will be the payment in advance. This will be the for the period applicable. So you have to consider this being the advance amount. 1 month. This is for 3 months. So you have to find out the 1 month value here into 1 by 3. 750 will be considered as your advance. 750 will be considered as your advance. Clear? So advance will be subtracted. Minus 750 advance. And the provision for doubtful debt is to be set at 4% of trade receivables. Provision 4%. Trade receivables. Okay. So here Provision for doubtful debts being 4%. No dividends were outstanding. No dividends were outstanding. No dividend. So this dividend available here, dividend paid on ordinary shares. Okay, dividend paid in ordinary shares may be paid. Do you find any other dividend outstanding here? No dividend is outstanding. So only this one is available. 1000 is to be transferred to GR. Okay. Retained earnings to GR transferable being $1,000. $1,000. Is that clear? Now we try to prepare, we will finish up preparing the income statement. Okay. Income statement. We'll start with revenue. Revenue being 2,03,600 minus cost of sales, opening inventory being 12,945, and with that you have to add the purchases 1,43,750, total value being 1,56,695. Find out if there is any carriage in. No carriage in, so from there closing inventory will be subtracted. Closing inventory, which is 12,830, and this ultimate value being 1,43,865. So this value being gross profit 59,735. Now expenses. Okay, rent and rates being the expenses. Rent and rates from 12,460, 750 is subtracted. Then the value being 11,710. Operating expenses, you have to add 415 with this. If you add, then the value being 13,335. Wages 24,380. Equipment, we can calculate the depreciation on equipment. Depreciation on equipment 40 minus 17,500, 22,500. On that 25% should be calculated, so 5,625. And trade receivables, an asset, but anyhow we have the PDD, provision for doubtful debts, 4% on this being how much? 4%, 392. But already we have the provision for irrecoverable debt 295. So there is increase. In case increase in provision for doubtful debt, that should be an expenses. In case of decrease, it's an income, like you can subtract this. Now the value here being 97 rupees, increasing the provision for doubtful debts. So whenever it's a provision, always cross verify with the existing provision, and only the change is going to be incorporated, whether it is increasing or decreasing. If it is increasing, it should be an item of expenses. If it is decreasing, consider this being the income addable with the gross profit. Okay. Bank asset, trade payables, liabilities, ordinary share capital, general reserve, retained earnings, and these are the items to be incorporated in the statement of changes in equity, and the total value here being 55,147, and finally your profit being 4588. Now statement of changes in equity. Statement of changes in equity. of changes in equity. Okay. And in the year beginning, what we have, these are the values. Okay. 1st December 2020 balance for equity, equity share, general reserve, retained earnings, and total. In the year beginning, we have 20,000 rupees equity, 3,000 general reserve, and 2,037 retained earnings. The total being 25,037, and profit for the year should be addable. Profit for the year we calculated here. This is what about the profit for the year. Addable with the equity retained earnings. So 4588. 4588. Dividend paid on ordinary share should be subtracted from the retained earnings. 1600 minus item. And transfer to GR. Okay. Transfer to GR. 1000 should be added to the GR and should be subtracted from the equity, and ultimate value being 0, and equity value being 20,000, and this will be 4,000, and this will be 4,025, and this will be 28,025. This will be the balance as on the last date, 30th November 2021. Okay. Question number 4. The trial balance of HV Limited. Trial balance given, then you have to prepare income statement. Prepare income statement for HV Limited. Okay. Prepare income statement for HV Limited for the year ended, and a statement of changes in equity. Let me start with this illustration. Okay. Inventory at the year end 1690 year end. Depreciation of our fittings is to be charged at the rate of 20% per annum. Depreciation on fittings is to be charged at the rate of 20% per annum using the reducing balance method. So fittings is here. After subtracting, you have to calculate the depreciation at the rate of 20% on this. Rent includes payment of 1800 for the 3 months period from 1st March 21 to 31st May 21 for the 3 months. But our account get closed on 31st March 21. So only 1 month is applicable and 2 months rent paid in advance. 1800 is for 3 months. For this 2 months into 2 by 3. 1200 rupees will be considered as advance. Advance should be subtracted from the rent account. So minus 1200. Accrued wages 2250. So outstanding should be addable. So 2250 should be addable. Rent will be your current assets and this will be your current liabilities. Anyhow, I am not going to prepare the financial statement here. No debenture interest has been paid for the year ended. So you have to calculate debenture interest. Okay, at the rate of 4% will be payable. Right. No dividends were outstanding. So dividend paid is there. And 2,000 is to be transferred to GR. Okay. Retained earnings to GR transfer being 2,000. This segment is all about changes in equity shares. Right. We'll start with income statement, revenue, 1,45,000 minus cost of sales. We start with the inventory opening inventory 5,820, add purchases with that minus closing inventory. If we have carriage inward, that can also be addable here. Purchases being 64,900, we don't have the carriage inward anywhere here. The total being 70,720 and closing inventory 1690 is subtracted from here. Then final value being 64,630 and gross profit here. Gross profit 80,370 less expenses. Rent and insurance 9,280, from there 1,200 is subtracted. 80 will be the answer. Wages, you have to add these two, as there is an outstanding, should be addable, so 27,000. Operating expenses 8,500 should be a part of expenses. Depreciation on fittings 2 lakhs minus 72,000, 1,28,000 on that 20%, 25,600. Trade receivables being the current assets, bank current assets, trade receivables payables being the current assets, and debenture interest is there. Now you first subtract this value, so this value put together 69,180. If I subtract, then the value being 11,190 is nothing but profit from operations. Profit from operation. Minus interest. Interest on debenture not paid. No. So for 30,000 rupees, 4%, 1,200 is subtracted. The value what you get here is called profit for the year. Profit for the year. 9,990. 9,990. Now, statement of changes in equity. Statement of changes in equity. Where we have share capital and general reserve, retained earnings, total. Year beginning 1st April 2020. So 1st April. I referred that from here. Ordinary share capital being 70,000. Retained earnings 21,500. We don't have the GR. So the total being 91,500. 91,500. And current year profit for the year should be addable. Profit for the year. 990 and dividend paid. Here is dividend paid 5,600 should be subtracted from here, and From retained earnings, it is transferred to GR. So 2000 should be subtracted from here and will be a part of GR. So 5600 minus item, 2000 plus and 2000 minus becomes 0. So this value is 70, this value 2000, and this value being 23,890. Overall value being 95,890. So carrying around 12 marks for these two illustrations. 13 marks. Okay, 13 marks. Question number 5. Q Limited prepares its financial statement to 31st March each year. What is the requirement here? Calculate retained earnings of Q Limited and statement of financial position also. Okay. Clear? Now, financial position statement is nothing but the normal financial statement you have studied there, but equity section is pretty different. Equity section is pretty different. Right. Q Limited prepares its financial statement to 31st of March each year. The company's retained earnings on 1st April 2022 were this much. 1st April 2022 retained earnings 16,250. During the year ended 31st March, the company made a profit of this much. So you have to add the profit for the year with this. Okay, 43,500. After charging all expenses and interest, the total dividends 39,000 for the year were paid. So dividend payment should be subtracted. 39,000. So in the statement of changes in equity, earlier we have studied, we need to prepare only this part to find out what is the retained earnings here. The following balances were extracted from the company's ledger account. So now you will be able to get the total value here. And closing retained earnings being 20,750. 20,750. Fittings and equipment and cost and provision for depreciation also be given. Motor vehicles at cost and provision for depreciation given. So these are non-current assets. Non-current assets. Inventory being the current assets. Balance at bank. Debit balance means current asset. Credit balance being the liabilities. Trade receivables current assets. Provision for doubtful debts will be adjustable in the trade receivables. Trade payables being the current liabilities. 5% debenture repayable in 29. So currently we are working for 2023. From there here it's more than 1 year. If the debt is repayable for more than 1 year, then automatically it is considered as non-current liabilities, and bank loan also be considered as non-current liabilities, and ordinary share capital being the equity. Now, statement of financial position. Statement of financial position. Under that, assets. There, we'll start with the non-current assets. First one being fittings and equipment. Fittings and equipment. Cost being 1,50,000. Provision for depreciation on this being 40,650. The net book value being 1,09,350. Then we'll go for the motor vehicles. 72,000. And provision for depreciation being 31,125. After subtracting this value being 40,875. So the total of non-current asset being 1,50,225. Then we'll add the current assets with this. In current assets, we have inventory. 51,790. Bank balance. Usually you can finish up trade receivables first and then you can write the bank balance. So trade receivables being 19,700 less provision for doubtful debts on that being 591, then ultimate value being 19,109, and bank balance 1076, okay, debit balance. So the total of current assets being 71,975. Total of assets being, you have to add the non-current and current. This will be the total assets. 2,22,200. 2,22,100. Now equity and liabilities. Under that, first you have to start with the equity section. In equity section, we have ordinary share capital. This value being 1,20,000 rupees. Retained earnings 2,750 we already calculated, should be addable. The total value for the equity being 1,40,750. Non-current liabilities, under that 5% debentures, 40,000. Bank loan 10,000. 50,000 will be non-current liabilities. Finally, leftover item being the current liabilities, trade payables. The value for this being 31,450. Okay. If you total this, you will be getting the total matching to the total assets. 2,22,000. 22,200. This will be the total equity and liabilities. Okay. Next question number 6. So prepare income statement, calculate retained earnings, statement of financial position for Q Limited. So you have to complete fully, even financial position also be prepared. Right. I'll start with the income statement, one of the comprehensive illustrations. So income statement. Financial position statement. Financial position. Okay. Of course, we can prepare changes in equity also, but they have asked only the retained earnings changes. Very simple. Retained earnings changes. I'll post that here. Retained earnings changes. And in the year beginning, 31st January 24, or 31st January 24, how much we have? 2,297. Okay. Finish of incorporating the adjustments here. The inventory at the end being 4,720. Inventory 4,720. Depreciation on fittings. This will be your current assets. Depreciation is to be charged at the rate of 10% per annum using straight line method. So 20% on this straight line method. Payment for advertising 75 is outstanding on 31st January. So 75 being the outstanding should be addable. No dividends were outstanding. So no dividend is outstanding means any dividend payable also considered to be paid. Now revenue, income statement, purchases income statement, rent and insurance income statement, director salaries income statement, general reserve, general expenses income statement, advertisement income statement, dividends paid, adjusted in the retained earnings, and fittings at cost, non-current assets, inventory in the beginning and the end, income statement and current assets. So this will be the outstanding, right? Outstanding being the current liabilities. This will be expenses being in the income statement. Cash at bank, current assets, trade payables, current liabilities, ordinary share capital will go to equity section of the financial position statement. And retained earnings, of course, you transfer directly here. Right. So we'll start with the revenue. Revenue here being 78,000 minus cost of sales. In cost of sales, we start with the inventory in the beginning. Opening inventory 2,950. Add purchases 32,800. No carriage in, so you add these to 41,150 minus closing inventory 4,720. Again, it should be posted in the current asset account, current asset side 4,720. The total being 36,430. If you subtract, then the gross profit here being 41,570 less expenses. Okay, revenue over, purchases over, rent and insurance. 10,600. Director's salary 19,000. General expenses 3,420. Advertising, this one is pending. Anyhow, 5,400 plus this one 5,475. Dividend paid should be subtracted from here. Retained earnings 2,500. And inventory in the year end also be completed. That's all. And we have to calculate the depreciation, which is 20% on this one. depreciation on fittings. 15,000 is 20%, 3,000. What's the rate of depreciation? 10%. Okay, 10%. This will be 10%. So 1800. The overall expenses being 40,295. If I subtract this expenses from there, profit for the year being 1275. Profit for the year. Profit for the year. So profit for the year will be now addable with this for the year. 1275. So retained earnings, you have to add these two and 2500 is subtracted. So the closing balance being 1072. Okay. Now in financial position statement. Okay. We'll start with the assets section. Non-current assets. Assets. Non-current assets. So we have only one item, fittings. Cost, provision for depreciation and net book value. Net book value. Cost 18,000. 5,400 initially, now we get another 1,800. 7,200 will be the overall depreciation here. So when you calculate new depreciation, that should also be included in the provision for depreciation. Thereafter, the increased provision for depreciation will be subtracted here. 10,800. 10,800. Okay. So 10,800 being the non-current assets. Then under current assets, we have inventory. This one. Inventory 4720 and cash at bank 915. Total being 5,635. Overall value being 16,435. And equity and liabilities. Under that, equity. In equity section, ordinary share capital being 13,000. Retained earnings 1072. The total value here being 14,072. In non-current liabilities, we don't have any item. Under current liabilities, we have been given trade payables 2288 and one more item to be posted here being 75. Outstanding advertisement expenses are advertising 75. So this value being 2363. Then equity liabilities total being 16,435. 16,435. Is that okay? Next, we'll move on to the question number 7. B Limited provides cleaning services to client offices and factories. The clients provide their own cleaning materials also. Okay. The trial balance of B Limited is given here. Right. And we have been given the additional information. You have to prepare income statement for B Limited. Then it comes under limited companies topic only. Statement of changes in equity also be calculated. Explain why B Limited has no inventory. B Limited does not require provision for doubtful debts. So these are the two additional questions also be asked carrying 2 marks each. So no inventory means as they are rendering cleaning services. In case of service sector, we don't have the inventory. That's how you can give the answer. Another being, why don't we have a provision for doubtful debts? If the entire transaction is in cash mode, there is no any outstanding to be recoverable. Only if the outstanding is recoverable, then we have the fear of non-recovery of any amount. Right. That's a logic. So we no need to bother about that. Here, that revenue also be received in advance. Revenue is also being in advance, so we never bother about any default. So provision for doubtful debt is not required. This is the logic. Clear? Okay. The directors of B Limited are also the shareholders. They plan to expand the company. They are considering whether it to issue debenture or ordinary shares. So you have to understand the advantage and disadvantages of issuing debentures and ordinary shares and write that here. You can score good mark. So my focus here to finish off income statement as well as statement of changes in equity. Let me start with this illustration. Yeah. Revenue being this much was received in advance, 9,240 in advance. 9,240 in advance. Advance means it should be subtracting from the original value received, and this will be your liability, current liabilities too. Insurance charges for the 12 months to 31st December 22 was 7,200, and for the 12 months to 31st December 2025 it is 7,440. Okay. On 1st January 23, insurance was paid in full for the 12 months period, 12 months to December 2023. Now, what is the year beginning and end? Year ends on 30th June 2023. So, 30th June 2023, I have to prepare from 1/7/23. For this period, I have to prepare. Right. For this period, you have to prepare. 1/7/22. Sorry, 1/7/22 to 36/23. 36/23. The insurance charges for the 12 months up to this date, okay, means 1/1/22 to 31st December 22, the insurance charges for this period being 7,200. And for the 12 months to this period, from here to this period, 31st December 23, for this period, 7,440. 7,440. Now we have to find out the insurance amount for this period only. For this period only. From here to here, how many months are there? 6 months. From here to here, we have 6 months. Out of 7,200, up to the first 6 months, 7,200 into 6/12, 3,600. Thereafter, 7,440 is for the entire 12 months, but I need to find out only for this 6 months into 6/12. Then this value being 3,720. 3,720. Now the total amount for that period of accounting being 7,320. Only 7,320 will be the amount for that period. Okay. So in case of insurance, 7,320. is the expenses. The difference between these two will be considered as advance amount. So for this period, maybe another advance 3,720. For this period, 3,720. Otherwise, you can write this way: 11,040, 3,720. If you subtract, what's the value you are getting? So you'll get the 7,320. That way also you can work out. No problem here. Clear? Now, accrued general expenses on this date, outstanding 186. So outstanding 186. You have to add this. Depreciation is to be charged on motor vehicles at 25% per annum using reducing balance method. Okay, motor vehicle. So you have to subtract the provision and then 25% will be calculated on this depreciation. Depreciation on equipment is to be charged at the rate of 20% using SLM method, straight line method. 20% on this value. On this value for equipment. No dividends were outstanding. 1,000 to be transferred to GR. Retained earnings to GR being $1,000. So now let me prepare the income statement. So income statement. Income statement. Under that, we start with the revenue. Revenue being 1,35,040 minus 9,240. 1,25,800. We don't have the inventory. Directly you can subtract the expenses from here. Okay. We have been given wages and salaries. Wages and salaries 72,000. Motor expenses 9,820. Insurance charges 7,320. General expenses, you have to add these two, 12,966. And equipment on this 5,000, 20% being 1,000. Equipment depreciation 1,000. And motor vehicles depreciation on that 42 minus 16,500 into 25%, 6,375. And trade receivables bank, and these are for equity statement. Okay, statement of changes in equity. So we'll finish up this one first of all. 1,09,481. 16,319 will be the profit for the year. Profit for the year. Now, statement of changes in equity. Equity change. Okay. The year beginning 1st July 22. Equity shares, general reserve, retained earnings, and total. Okay. Equity share being 10,000. General reserve 2,000. Retained earnings 13,490. Profit for the year we have identified or calculated here, so I have to add this 16,319. And dividend payment will be subtracted from the retained earnings 4,800. And retained earnings to GR transfer 1,000. In GR, that 1000 is added. Here, that 1000 is subtracted. The closing value here being 30th June 23. Equity remains the same, 10,000. GR 3,000. Retained earnings 24,009. You can get the total also. So here 25,490, 16,319, 4,800 negative. This will have no balance. Total 37,009. You need to get the total of row column also. For that you get 1 mark. 1 mark for this, 1 mark for this, 1 mark for this, 1 mark for this. Stating that it is 0 also carries 1 mark. And finally 37,009 also carries 1 mark. Okay.